This is the luxury world. Get inspired with us today and tomorrow. While historically near impossible, whispers circulate that the window to buy coveted luxury watches below retail prices might be cracking open. Latest trends signal a potential shift. The prices of watches are decreasing significantly. Many Rolex models are now accessible for purchase at authorized dealers. Additionally, most other brands are offered below retail prices on the secondary market. There are even reports of advertisements offering discounts. What is the reason behind this trend, and what implications does it carry? In this video brought to you by the Luxury World, we will be talking about the luxury watch market to see what is going on with the prices and to analyze the current market shift. If you have not subscribed to our channel yet, we strongly encourage you to do so now to keep updated on our upcoming video releases. To start, let us take a closer look at the current market situation. We are all familiar with the broad strokes of the narrative from 2019 to 2022. During that time, prices and availability went through the roof. Anything considered desirable was not only hard to find but in such short supply that there was a thriving market for selling watches well above their retail value on the secondary market. This attracted flippers, gray market dealers, and individuals promoting watches as investment opportunities. What is crucial to note is that the peak of the Rolex hype occurred between 2019 and 2022. This hype had begun building as early as 2015, around the release of the ceramic Rolex Daytona. From 2015 onward, companies started taking steps to address the situation. In 2018, brands began repurchasing stock, primarily to safeguard their brand integrity. There had been an oversaturation of watches in circulation for years, with watch brands pressuring dealers to accept massive quantities of both popular and unpopular models. For every sought-after Omega 300M, dealers were burdened with less desirable models like the Gem Set Omega DeVille. The strategy for watch manufacturers was volume-centric, aiming to fill display cases and maximize advertising visibility. However, this led to excessive stockpiles of unsold watches, which were consequently dumped onto the secondary market, causing a decline in brand perception. Understandably, consumers were reluctant to pay full price when significant discounts were available elsewhere. Consequently, production was scaled back, coinciding with the onset of the COVID-19 pandemic, which further disrupted travel plans, prompting increased watch purchases. Also, prices surged while availability plummeted. Now, we are observing a reversal of this trend, with prices beginning to decrease. The Rolex heat map is shrinking, with two-tone models becoming more readily available. Similarly, the Edge models are now accessible. This trend extends to other brands as well, where some of their models can be acquired without much difficulty, typically within a month. The anticipated Christmas surge in sales did not materialize as expected, resulting in premium brands like Rolex being sold at bargain prices on the secondary market. Many high-end brands are experiencing a decline in desirability for several reasons. Swatch recently released its annual report, indicating an impressive performance in 2023 but notably lower than in 2022, with a slowdown observed towards the end of the year. Despite remaining optimistic for 2024, there were acknowledgments that the previous frenzy had subsided. LVMH also reported a slowdown in their watch business. Watches of Switzerland are forecasting a significant downturn, reflecting the frontline perspective of industry insiders. Regional variations exist, with Europe showing pessimism in purchasing behavior, while emerging markets like the Middle East and parts of Asia are experiencing rapid growth, fueled by increasing millionaire populations. According to a report by a global consulting firm, consumer perceptions of value and brand differ across regions. In the US, France, and Germany, consumers prioritize value to price ratio, whereas in India, the Emirates, and China, brand image remains paramount. Manufacturers recognize the growing impatience among consumers and the risk of losing them to other brands or not purchasing them at all. The golden days have faded, and while there is some cautious optimism among producers, it is not as robust as before. It is not a sudden crash, but manufacturers cannot anticipate empty ad spaces in 2024. Some pieces will linger unsold. Several factors contribute to this shift. Inflation, economic slowdowns, and reduced disposable income have dampened consumer spending. Investors and flippers have also become less involved. Additionally, watchmakers have increased prices excessively and based business decisions on outdated pandemic-era data. Adjustments in production and model releases take time, so choices made in 2021 and 2022 are only manifesting now in late 2023 and now in early 2024. The influx of releases in 2023 aimed to cater to the demand of a voracious 2022 market, but consumers eventually ran out of expendable funds and patience for elusive models. While enthusiasm for appealing watches persists, consumers are now more cautious and critical in their approach. We anticipate some degree of oversupply, partly because brands are cautious about falling short of meeting demand, given the negative sentiment generated by past stock shortages. Compounding this, consumer demand has waned, resulting in an imbalance of excess supply and limited demand. This scenario suggests further price drops, increased availability, and easier access to watches. While a market collapse seems unlikely, we expect a return to a more typical situation where most watches carry a premium tax but can be acquired below retail, depending on brand and model popularity. Moving forward, manufacturers facing slowing demand will need to reevaluate their pricing strategies. Simply hiking prices by significant margins is not a sustainable solution. Instead, they will need to focus on their value proposition and pricing structure, striving to maintain margins while minimizing price increases to entice buyers back. Rolex provides a noteworthy example, with more modest price increases this year compared to previous trends, and in some markets, prices remain unchanged, indicating a shift away from excessive greed. While effective during periods of high demand, in times of consumer hesitancy, manufacturers must weigh the expense and risk associated with these releases. Cutting back on the number of limited releases and evaluating their popularity and potential for generating volume through other means may become necessary. In times of ample profits, taking such risks is viable, but when inventory sits idle, investing in additional limited editions may not be prudent. When faced with pressure on sales volumes, brands have a choice to make regarding new releases. They can opt for a variety of new variants, models, and options, or they can stick with what they know works. Typically, larger brands tend to be more risk-averse, prioritizing stability over innovation to safeguard their market share. While this approach may not always be the most effective, it is considered safer in uncertain times. Marketing becomes crucial during such periods, as highlighted by Swatch, which emphasized the importance of marketing activities in driving sales. However, there is a tendency for businesses to cut back on marketing when faced with declining numbers, which could be counterproductive. Those who maintain or even increase their marketing efforts are likely to fare better in the long run. Additionally, consumer preferences are shifting towards smaller, niche brands that offer perceived value. Examples like Formex and Christopher Ward provide high-quality watches at affordable prices, attracting consumers who find bigger corporate brands too expensive for what they offer. This shift might prompt larger brands to innovate and improve their offerings to remain competitive. Movement innovations, bracelet designs, and overall specifications will become crucial for justifying premium prices. Demand for high-end brands may contract, with more pressure on peripheral brands, while a core group of perpetually desirable models from brands like Patek Philippe and Rolex will continue to attract buyers. In the enthusiast community, the next few years could see an upturn, with increased availability of desired watches and potentially even below retail prices. As the economy gradually rebounds, consumer confidence will improve, leading to renewed demand. However, this cycle of price fluctuations driven by consumer behavior may continue unless significant lessons are learned by the watch industry. For now, availability and catering to regular customers are paramount. What are your thoughts on the luxury watch market update we shared in this video? We would like to see your answers and opinions in the comments section. If you liked this video, let us know in the comments section below. Remember to follow us too and give us a thumbs up. Once again, this is the luxury world, and we look forward to seeing you again in our future videos.